Hey everyone, welcome. We have a special video for you today. It's not often that I release an hour-long video on my YouTube channel. In fact, I never do this. The only reason that I'm doing it is because I think this video is so good that it's worth the time. I really think you're going to enjoy this information. This is part one of a three-part series specifically on Amazon. And this is a big part of the reason why I invested $35,000 into this company, and it's since become my biggest holding. So this video really outlines my entire bull case on Amazon, from the entire business, the fundamentals, the valuation, how I view its future growth prospects, the downside, everything that goes into it. And I also think that it's more insightful than most of the content you get on YouTube. So I think you're really going to enjoy it. I had filmed this 6 weeks ago, so it's fairly recent. It was a Patreon exclusive, but I just had so many patrons telling me, look, this is too good just to have, a couple thousand people watch it. We need to have more people see this because it's just information that should be shared with more people. So that's what I'm doing now, releasing part one. I hope you enjoy it. And again, if you want to see part 2 and 3, you can either wait until next Friday and the Friday after that, or you can jump in line and join the Patreon. You can see them all right away. But having said that, let's go ahead and roll the tape. Oh boy, we have a video to get into today. This is going to be a fun one. If you're new here, I do these from time to time. These are exclusive episodes, deep dives into different subjects and topics that are on my mind. And this is such a deep topic and one that I want to discuss in such depth that I'm actually going to make this one a 3-part series. So this is the first installment out of a 3-part series. And I don't know how long this video is going to turn out to be. I can't see the future, but I'm assuming it's going to be a longer discussion. We have a lot of content to get into. So go ahead and grab your favorite drink, settle in. We have some serious discussion to get into. I hope that this video helps you, helps bring a new thought process, not just content. Everybody's creating content. For the most part, I think it's fair to say that most content goes in one ear and out the other. And it takes time to find something that really makes you go, wow, I'm thinking about something differently than when I started this. I'm actually considering things in a different perspective. That's what I'm hoping for in this video. So over the next 3 videos, in fact, since this is going to be a 3-part series, I want to discuss one company that's on my mind. It's been on my mind for the past 3 months. Everybody knows it's a good company. And because it's so familiar, we may all think we already know everything there is to know about it. This has already been researched. It's one of the most covered companies in the entire world. What can we think that's new about this company? What insight can we have? That's where I think we're missing out. I think there's a lot of things we don't know about this company. I think there's a lot of unrealized value. And no matter how much I look at all these different companies, for instance, doing content creation full-time in finance, I am literally all the time looking at everything I can. All the different content that other creators are making, all the different stuff people are writing on Reddit and Seeking Alpha, stock twits, all this stuff. I'm consuming all of it, and I see all the discussions on all the different companies, all the different growth companies, whether it's Palantir or Snowflake or Twilio or all the dividend-paying companies, all the different ETFs. Everybody has different ideas with investments. And I look at all of this and I keep coming back to a group of companies that no matter how many times I look at all these other varying investments, I just keep coming back to these groups of companies. I think that they're just better investments overall. The companies are big tech. I think that big tech still remains today superior investments than almost every other company in the market. You can pick different companies in the market and you might get lucky and have one do really well. But I think with big tech, it doesn't really require luck. And within big tech, I want to talk about one company in particular, one that I am becoming more and more convinced over time. This company has an incredible path of growth ahead of it. I look at what they're doing, where they are in their arc of growth over the grand scheme. And the more I do research about this company, the more I'm convinced that investors really are not pricing in its future. And the company is Amazon. That's the one that we're going to be talking about for the next 3 videos. So before you tune out and say, I've heard enough of Amazon, and, before you tune out and say, Joseph, you like to invest in big tech and, you don't talk about other opportunities in the market. You're too focused on big tech. I want you to hear the reasoning behind this. A lot of us look at Amazon, for example, and we say, It has a $1.55 trillion market cap. And we think our natural assumption is that because it already has a massive market cap, it can't possibly continue to provide superior gains to other smaller companies that have more room to grow. And because it has a high PE ratio, that's a proxy for saying the company's expensive. My argument here, and over the next 3 videos discussing this argument, is that Amazon is both those assumptions are false. Amazon has an incredible amount of room to continue growing, and the company is not expensive. I don't think either of those assumptions are correct. And the more that I look at this and look at the different options, I actually think that Amazon in particular remains a cheap company based off of its future growth, a cheap company based off of its margin of safety, potential downside. And that's what I want to discuss today. Now, to dive into this subject, I'm going to be referencing research by Nayut. I think that's how you say his name, not positive. But he says, he has a lot of different thoughts on this. And I think his write-ups on this, his thoughts on this subject, I think are just phenomenal. So I want to share them with you. When I find treasures like this, I just want to share it with other people. So let's go ahead and go through this subject. The first pillar of this is a setup of why he thinks that big tech companies are systemic undervalued. They're perpetually and consistently and continually undervalued. And they have been that way for 20 years, and they still are today. They're dramatically undervalued compared to their risk factors, the other alternatives for investment, their future expected return. And he explains why that's the case. Most people don't think this is the case. They think that the big internet aggregators like Microsoft and Apple and Google and Amazon and Facebook, that they're overvalued. They're very expensive. They had a big run up, and look at the past. They're big companies. And so now they're kind of big bubble companies that are overvalued. He explains just the opposite. And this whole first part, this whole first video is just the foundation of why that's not the case, why these companies are actually undervalued. He starts off the new normal. And again, this is, it's interesting because the thoughts that he shares are in many cases the exact opposite of the thoughts that Cathie Wood just shared on CNBC a few days ago. Polar opposites. She's saying that these companies are the ones to avoid. That's where the risk is. Invest in our companies that are all these like newer, smaller tech companies. And his ones are just the polar opposite. When I look at both sides of the research, Cathie Wood's argument and ARK Invest and his, I much prefer his. I think that he's correct. I think it's the truth. He says big tech and the emergence of the internet era aggregators and platforms require a fundamental rethink in how we structure an investment portfolio. We are in the early stages of this fundamental rethink, which has caused shares of the most successful aggregators and platforms, big tech, to be continually undervalued, although they are the most well-researched stocks. So you might make the natural assumption that because a lot of people have heard the names of Google and Amazon and Microsoft and Apple, that their valuation is fair value. That investors, all the brains of all the investors all across the planet, all of them together with our knowledge and research and data, we're approximating a good price for these companies. And he's saying that's not the case. That we're wrong. We have been wrong. They're still undervalued today. This systemic undervaluation will likely persist and only gradually reduce over time as these companies mature and investors better understand this new market landscape. The current supply-demand imbalance of big tech shares provide a significant opportunity for unconstrained investors, i.e. retail, to buy these companies at a deep discount today. So by retail, you mean unconstrained. If I was managing a portfolio for like a client, or I was actually managing someone else's money, then I have all these fiduciary responsibilities. I have all these things I have to do. I couldn't put all the money in big tech. That would be irresponsible by the government, and I could get in trouble for doing that. But he's saying when you're unconstrained, you're just a retail investor, you can take advantage of this type of stuff more easily. A portfolio compatible with this new reality should be more concentrated with a larger maximum position size. Many foundational practices of how investors structure a portfolio today were primarily built on data and realities of the pre-internet world, where internet-enabled aggregators and platforms did not yet exist. Okay, so let's break down this last sentence. There's a lot packed in there. He's saying that the foundational practices, so like financial theory and how you manage portfolios, for how we do things now was structured pre-internet. So the rules and the kind of way that we structured portfolios predated the internet. For example, the SEC rule that places a soft cap of 5% on the maximum position size for a diversified mutual fund came out in 1940, while the modern portfolio theory, that's what basically everything follows right now, was introduced in 1952. The corporate competitive landscape back then was also more intense. Fewer winner take most outcomes. And without the internet, the largest companies in a given industry weren't able to aggregate demand to the same extent current aggregators are able to. So aggregators, a company that aggregates a lot of people into one product or platform, they've always existed. And those have typically always been the best investments. But what the internet's done is made aggregation even more intense and even more concentrated. To elaborate this point, in the internet era, the companies who become dominant aggregators or platforms have vastly different competitive risk profiles than the industry leaders of the pre-internet era. Even when there is more than one successful aggregator in an industry. Retail video on demand. They don't always directly compete head-to-head, but rather offer complementary products and or focus on fulfilling different demand types. He's saying this reduces risk. As an example, Netflix and Disney. Both of these act as aggregators. As a result, the concentration risk is not nearly as high as history would suggest when taking a large position in a winning aggregator / platform due to how this now altered competitive reality. For these dominant companies, valuation risk is often more considerable than company-specific risk. However, the relative and absolute valuation risk of big tech is currently quite low. Increasingly, the market is moving towards having fewer, larger, and more durable quality companies. This is something that I think is clearly going on. There are going to be more winner-take-all, more consolidation of industries. The part of the reason I put so much money into Costco, even at an expensive price, a high PE, is I think that Costco is going to consolidate a big part of physical retail. I think they're just going to continue to engulf and consume and take share from all these smaller stores. Like they're clearly one of the market leaders and aggregators. So I see this dynamic happening. I agree with him 100%. He says, for example, this is a better example that he brings up. The advertising market evolved from thousands of then wide moat TV stations, radio stations, and newspapers globally to now with over half of the demand aggregated by Google, Facebook, and Amazon alone. 3 companies take over half the demand of advertisement. The internet generally shifts demand from companies operating in the middle of the pack to a few truly scaled winners. One should not be underexposed to these winners, especially at their current valuations, simply because of historical rules or theories created decades ago. The more diversified portfolios, which underweight big tech, may in fact have inferior risk-reward profiles. So, if you're saying the big tech companies are too big and you want to focus on other companies that have more room for growth, you're probably weighting your portfolios incorrectly. You probably should have actually a higher weighting towards these big tech companies. Now, for this next part, we're going to focus on Google and Facebook, and then we'll jump into Amazon. He goes over all 3 of them, and I think it's good because it kind of shows how big tech is being valued and how it completely understates the valuation of these companies, how expensive they really aren't. Google and Facebook are trading at 20 and 15 times their core business earnings today. Just to reread that, 20 and 15 times their core business earnings. We arrive at these figures by assigning a conservative valuation for their non-core businesses, removing the non-core operating losses and subtracting the cash on the balance sheet. Doing so makes them more comparable to most other publicly listed companies. So if you actually value them like other publicly traded companies in the S&P 500, they're really trading at not high valuations, 15 times and 20 times. Google's sales have grown 23% and profit 25% per year over the past 5 years, and likely will see at least low teen growth rates over the next 5 years. Isn't that incredible? 25% profit growth over a 5-year period, and they're still going to see over 10% profit growth over the next 5 years. Facebook has grown even faster, and will likely see at least low teen growth rate over the same period. However, Facebook is priced around the same level as tech names like IBM and eBay. Both Google and Facebook, interestingly, are priced well below household names like Coca-Cola, Procter & Gamble, McDonald's, despite their relatively stronger growth potential. Now, isn't that a little nuts? Google and Facebook are trading at cheaper prices. The market is discounting Google and Facebook more than it's discounting Coca-Cola, Procter & Gamble, and McDonald's. Consider that, and then talk about the efficient market. Why are investors discounting Coca-Cola, Procter & Gamble, and McDonald's more than Google and Facebook? Why are they paying a higher multiple for those three companies than Google and Facebook? Do you know why? This is an argument that I've made many times on my channel. When I first purchased Apple at like 90, it was below $90 a share was the initial one. My big argument was, why is Apple trading at a 20 PE ratio with the rest of the market? And why is it trading at half the PE ratio of companies like Clorox, McDonald's, Coca-Cola, and Procter & Gamble? A lot of those are like 35, 40 PE ratios. Here's Apple trading at a 20. Why? Why does that make any sense? These big tech companies like Google and Facebook, they're growing their earnings much faster. They're growing their revenue much faster. They have possibly wider moats, less likely to be disrupted, and they have at the same time much superior balance sheets. Compare the balance sheet of Google and Facebook, which have next to no debt. Google has like $12 billion of debt and $140 billion in cash. Facebook has no debt and like $50 plus billion in cash. So they are indestructible in terms of their finances. They can fund their businesses for a decade without getting any new net income. It's just incredible the amount of money that they have on hand. You compare that to Coca-Cola, Procter & Gamble, and McDonald's. These companies are not cash rich. Look at how much debt they have and how much cash they have. They're not cash-rich businesses like Google or Facebook. And more to the point of that, he has this chart here, which I'll show you. It has the normalized net income of the 5-year CAGR of these companies. So on a normalized net income, how much they've grown that net income annualized on a 5-year basis. And he compares that on the x-axis, it has the trailing 12-month PE ratio. So as you move further to the right, the more expensive the company is. And as you move higher, the faster the company's growing. You might notice these companies, Facebook, Google, Apple, and Microsoft, they're growing their earnings incredibly fast, way faster than the majority of companies down here. But every company off to the right of them is being priced more expensive than these companies. So I think this chart really does illustrate that when you compare these four companies, Microsoft, Apple, Google, and Facebook, to other wide moat companies, they are on a normalized basis much cheaper for the growth that you're getting. They are being discounted more than all these other companies. We have Visa, Costco, Estee Lauder, MasterCard, PayPal, Adobe. All these companies on a growth adjusted, earnings adjusted basis are more expensive than big tech. Now, why is that? The argument, if it's not just, that they're overvalued, it must be something else. And a lot of people point to regulatory risk. That's the big risk for big tech. Now, I get questions about regulatory risk for big tech all the time. It's never been a big concern of mine, never been something that I'm overly concerned about. And he shares a very similar sentiment as well. I agree with his take on this. He says, the most common threat cited for big tech is regulatory risk. However, the current valuation discount does not justify the likely true risk. The internet ushered in a new paradigm that allows for the creation of dominant aggregators and platforms where demand flows to the largest operators who can best leverage their initial demand so they have the initial lead to attract even more incremental demand. That is what an aggregator does. Regulators can indeed break up these companies, though the aforementioned fact remains. More specifically, that in the fullness of time and across a number of verticals, one player will still ultimately aggregate most of the market demand within an increasingly digitally driven world. Even in the face of a more restrictive regulatory environment, there are many ways to create ongoing shareholder value among big tech. Regulatory intervention may force them to abandon their best option, but their second best options is not often significantly worse. All things considered, additionally, with the exception of Apple, big tech, and it's funny that he outlines Apple because they use a lot of their force here. But he says, additionally, with the exception of Apple, big tech does not seem to exercise the full extent of their power. So he outlines Apple as one of the companies that really pushes the limits with how much power they exercise. And I agree with that. The App Store is, for instance of that, an example of it. I think Apple push their power a little too much with the fees on the App Store. I think they should lower them. Even though they don't have to, even though it's legal and they're fighting the battle in courts, I think they should, because I think the power they're exercising invites regulatory restriction in the future. Anyways, he says, with the exception of Apple, big tech does not exercise the full extent of their power. And this is absolutely true. And instead voluntarily holds back in an attempt to minimally, in some cases, appease regulators. That's exactly what most of big tech does. They could force their hand much more than they currently do, but they don't want to give regulators a reason to regulate them. In short, regulation would likely cause big tech's earning growth to slow somewhat, but it likely won't materially alter the overall business prospects. So I completely agree with his assessment here. I think that investors are way over discounting the threat of regulation on these big companies. And not only for the reasons that he mentioned, that these companies are not going to be damaged by the regulation to the extent investors are expecting. They're really good at pivoting around regulation. They've been regulated before in many cases, and they're still just as profitable. Google got regulated a lot in Europe. They're just fine in Europe. They're making lots of money. It doesn't destroy them. They just have to do a next best option, and they still work around it and make money. Regulations will happen, but it's not going to change directionally where these companies are going. Another point I'd bring up that he doesn't mention is, I think to some extent, these companies, Apple and Microsoft, do you think the US is going to want to destroy these companies? Like the Congress is going to want to be blamed for destroying Microsoft or Apple? Our shining beacons, the best things that the US has to offer in the capital markets, probably the thing that we're the most proud of as a nation, is having this amazing capitalist market where we have lots of prosperity and wealth and things that we enjoy, provided in large part by major corporations. That's where a lot of the GDP, a lot of the tax revenue, a lot of our standing as a nation being competitive with China and the rest of the world. And I don't think they're going to want to handicap us by destroying these companies. I think that'd be, incredibly unlikely. So I think they'll do, positioning, political positioning, and the talk. We're against the big companies. We're for the people. Really, they know I don't want my retirement to go to zero. I don't want to destroy the economy. So I'm really not going to destroy these companies. I think they say one thing, that they're going to be really tough against big tech. Then when they realize that they might actually destroy the US economy, if they actually broke up and did a lot of these crazy regulations, I don't know if they're going to go for that. So I agree with him. I think that even if the government did try to regulate these companies, I don't think it would destroy them. And I think that they're unlikely to do the same aggressive regulations that people are expecting, or at least that investors are discounting. Now, keep in mind, the whole purpose of this write-up of his is just to give a framework and foundation of why big tech companies remain undervalued today. How is that possible? That's the whole purpose of it. He continues on saying, non-fundamental systemic reasons can much better explain the undervaluation of big tech versus any fundamental rationales. So we've gone over the fundamental analysis. These companies are so dominant, nobody can stop them. They print cash. They're like the Fed with how much money they print. They have indestructible balance sheets. They have extremely wide moats. They can crush other businesses, and regulation can't really do much to them. Like the regulatory environment's not going to stop them either. So why are they undervalued? He says that it's non-fundamental. The fundamental reasons don't explain the undervaluation. It has to be non-fundamental. And he goes over a couple different reasons. Section 5B1 of the Investment Company Act of 1940, existing incentives of the investment management industry, and the availability of growth investment dollars and over-diversification. So let's go ahead and dive into these. The 5% rule. This is kind of like portfolio management. The Investment Company Act of 1940 puts a 5% soft cap on the largest positions of a fund that a fund can hold for those who seek to market themselves as, quote, diversified fund. It is a soft cap, as there are exemptions. 1, 25% of the portfolio is exempt from this rule. And 2, when over the limit, the fund can continue to hold, but cannot add to those positions. Because most mutual funds are marketed as diversified funds, it is increasingly difficult for them to overweight big tech without breaking this rule. This is especially true for growth-oriented funds, who traditionally make up a significant portion of the shareholder base of big tech. These funds have to manage their big tech exposure more aggressively and have been large net sellers of big tech shares over time. This contributes to the aforementioned share supply-demand imbalance. And while there are funds who successfully gain permission from their shareholders to drop the diversified fund requirement, many often don't take that path. So he shows that, over time since 2015, the FAAMG, average mutual fund over and underweight, has dropped over time, become more underweight instead of overweight. Incentives in the investment management industry. So we have incentive issues here. Even if the rule above were to be adjusted higher, active managers would still need to justify their fees. Generally speaking, active managers need to find hidden gems, non-consensus ideas, or things of a nature that produce excess returns. That's not just for funds. That's also for YouTubers and content creators. Just making videos of how great Amazon is probably a much better risk-adjusted return than companies like Palantir. In my opinion, much better. I think it will prove to be a much better investment over the next 10 years. But that doesn't justify people's time. So you have to be creative and try different ways to justify people's time. So a lot of content creators take the avenue, instead of focusing on companies that are just their home runs. I mean, you just knock the ball right out of the park with these companies like Google and Amazon and Apple that you can buy and they just go up in price and they're incredibly easy buys and they're easy money to some extent. Instead of making videos about those, that's not interesting enough to get enough clicks. You have to justify the content here in a different way. So you make content about unknown companies that you can dive into and do research about that are more fascinating, that are more secretive, that are more elusive. That's how you do it. And you monetize that relationship. This is the issue with incentive structures. And it's the same thing on YouTube and Twitter and content creation as it is in the investment industry. I make so much content about, relatively speaking, boring companies that don't get a lot of clicks. Companies like Apple, Microsoft, Amazon, Google, and Costco. I've made tons of content about those companies. They're super known. A lot of people think that they're boring. They wish I would talk about other more exciting companies. But my incentive is not to try to justify people's time as much as it is to try to get them the best information. Companies that actually think are home runs, that are the best deals. So keep in mind the incentives that are going on here. He outlines it specifically talking about with managers. He says, as such, it is very difficult to raise funds from institutional investors if much of the fund's portfolio is predominantly comprised of very well understood companies like big tech. So consider this. If I'm a big time money manager and I run a fund and I'm trying to get more and more assets under management, this might remind you of a certain, a lot of them. It's not just Cathie Wood and ARK Invest, but a lot of them. Any hedge fund or any fund, you're trying to get assets under management. That's how you make money. You make money by getting assets under management, not by the fund doing well, but by getting assets under management. So performance can help get assets under management, but also marketing is a huge part of it. I've listened to these guys on Twitter that actually run funds, and a big part of their job is marketing. How do I market my portfolio to get assets under management? And the discussion is very interesting because the feedback that one person did that gives a lot of feedback to different fund managers and hedge fund managers, right? Portfolio managers is, man, this is going to be a tough portfolio to sell. You got Amazon in there. You have like Apple in there. You have like 7 holdings and like half of them are big tech. Going to be a tough one to sell. You're not going to be able to get a lot of assets under management with that because the investors, of course, will feel like they can do that themselves. So what does that force fund managers to do? It forces them to be more creative with their portfolios because their portfolio of the strongest, best valued, least risky companies, i.e. big tech, is not an easy marketable portfolio. It forces them to reconstruct their portfolio in order to sell it because their goal, again, their incentive is to get assets under management. And I would relate that to YouTube as well. The incentive there is to get clicks, not to just get the biggest home runs. The biggest home runs in the market are Amazon, Google, Apple, Facebook, Microsoft. Those are the biggest home runs in the market right now. The incentive is different though. Most content creators won't spend much time talking about that. They'll talk about much more exciting, unique, compelling companies that make people click on them, that get them more excited about it. Likewise, fund managers do the same thing. They artificially change their portfolio to one that seems more creative and different, more random, insightful than one that's boring and just has the biggest home runs in it. Active managers are given a difficult task of having to, one, underweight the most undervalued shares. He's suggesting that the most undervalued shares in the market are big tech. Two, choose to overweight shares from other groups of companies that as a whole underperforms the market in every one of the last 5 years. And three, beat the market returns after layering fees on top. To date, very few active fund managers have shifted to become overweight big tech. Even the ones that do so often don't do so by a significant margin. The consistently lower than normal demand for big tech shares among active funds subsequently cause big tech to be consistently undervalued. So he thinks this is another reason, and I agree, why big tech remains undervalued. All the big money managers can't throw all the money they want into these companies because they would lose assets under management, because what are they doing to justify their fees if they're just buying big tech? And on the contrary, there's a few of them, a few smaller investors that have just thrown most of their money in big tech and have just said, yeah, that's what I'm doing. Nick Sleep is one of them. Remember Nick Sleep? He has like 2 holdings. He had like Costco and Amazon. Literally 40% of the fund was Amazon. And he was shameless about it. Yeah, what I do is very easy. All the money is just in Costco and Amazon. Don't care. You can do this yourself. In fact, after I think it was around like 2010 or something, he ended the fund and said, look, all you have to do is just keep it in these 3 companies. Don't change anything. That's what he said he was doing. So those type of investors that weren't just seeking assets under management and they were 100% focused on just beating the market, they did put their money in big tech and they beat the market. That's what Nick Sleep did. He just put his money in Amazon and beat the market because he thought it was the most undervalued company. Most of them don't do that. Most big money managers could never sell their fund if it was all in big tech. And like you're seeing right now with Cathie Wood, her CNBC appearance where she's warning about big tech, saying that's where the risk is. Our companies like Roku are the more disruptive and innovative companies than Amazon and Apple and Microsoft. Give me a break. This is pure marketing, in my opinion. I don't think she can sell her fund if it's just invested in big tech. Every single thing you can look at, these companies, Amazon and Microsoft and Apple and Google and Facebook, are thousands of times more disruptive and innovative than Roku or than DraftKings or than Robinhood. What did Robinhood do besides 0 fees? They were disruptive in one thing, which every other company quickly replicated. And what has Robinhood done since then that's innovative? I could go on this subject, but I completely agree with him. Obviously, the goal of funds like Cathie Wood's is to get assets under management, to charge her 0.75% fee, and to bring as many people on board so she's managing as much money and collecting as much of a fee. It's not just to have it perform well. She probably wants that as well, but the task becomes more complicated because she's trying to invest in companies that are going to underperform. She's going to charge a fee on top of that, and then she's going to try to outperform the most undervalued shares in the market, which are big tech. So I, again, completely agree with him on this. And he shows how basically every other investment strategy besides big tech over the past 5 years has not returned as well. We have big tech's total return here. 2017, 45%, 2018, 3.6%, 2019, 51%, 2020, 56%, 2021, 36%. Look at these returns. Take a look at this. Just incredible returns here. If the big tech weighting was more in any case in the past 5 years, you would have made a killing on these. Now, let's continue on though. Over time, the rise of the aggregator and platform companies would be quite disruptive to active equity managers. The active investment sub-industry is built on the idea that value can be added by finding inefficiently priced shares among the broader market of publicly listed equity securities. While we only have 5 big tech companies today, we are certain to have many more in the future. A growing percentage of the aggregator market cap, I think there's some ideas I have that might become big tech in one day, but a growing percentage of the aggregator market cap of all publicly listed companies is shifting towards these few dominant, very well researched and understood companies. The business of the middle of Ben Thompson's smiling curve, where the above average stock pickers can most differentiate themselves, are hollowing out. To be sure, there are many industries that won't see the disruptive shift brought by the likes of big tech. Even still, much of the incremental aggregator profit dollars and market cap across the universe of listed companies is going to accrue to these aggregator and platforms, making them an ever larger percentage of the overall stock market index. So you might think it's absurd, that the S&P 500 has like 20% of it in just these 5 companies. It's probably going to be like 40%, 50%. A growing portion of the equity market will be in these companies. The burden of underweighting these companies should only increase moving forward for managers that must underweight them. So the ones that are forced to, by the things that we already talked about, their incentive structure, it is akin to playing on hard mode, which only gets harder every year. I think that that's the most compelling reason overall of why big tech is underweighted. Or underweighted in people's portfolios, underweighted in big hedge funds, underweighted in money market funds and mutual funds. A lot of it has to do with incentive structure. Again, when you're talking to people, a question I have for them is, why not Google? They talk to me about companies A, B, C, and D, and you might ask them, why not Google instead of those companies? See what their answer is. See if they can give you a fundamental reason of why they're buying this other company aside from Google. You could ask the same thing for a lot of money managers. Continuing on, the availability of growth dollars. This is another reason these companies are undervalued. The overall allocation of investment funds to public growth equity is roughly 30% of the market. As shown in the table below, the pre-internet world, companies reach maturity at lower revenue bases and therefore behave like a mature company at a far smaller scale than today's technology giants. But for big tech, and especially the less mature ones, Amazon, Google, and Facebook, they can continue to behave more like typical growth companies today. The issue, however, is that there aren't enough incremental growth investment dollars in the market today to cause the upward movements in big tech shares to be at the same rate as their fundamental growth. So he's literally saying there's not enough money allocated to growth strategies to represent their fundamental growth. So as big tech's profitability grows, they find it harder to attract incremental demand for their shares, which must come from primarily non-growth investors. Probably like me, like dividend investors, people that invest in a different style. The big tech's heavy investment in growth, coupled with their lack of dividends, hurts their prospects among non-growth investors. That's absolutely true. I don't have Google or Amazon in the passive income account because they don't pay a dividend, particularly as growth investors move to invest more into less mature companies, in addition to non-growth investors' reluctance to over-index big tech. The big tech experiences the previously cited abnormal demand for their shares, which subsequently drives their systemic undervaluation. So a lot of the reason that not enough capital is allocated to justify these companies' positions in growth is because of portfolio positioning. Big tech has simply outgrown the availability of growth investment dollars. They're growing faster than their category allows to keep up with their investments. Pretty incredible. The next one's over-diversification. Most investors' discomfort with concentrating their portfolio amongst their largest positions may be the most significant contributor to undervaluation of big tech. Warren Buffett's certainly fine with this. He has like 40% of his portfolio, the public one, in Apple alone. A lot of people think he's crazy. They don't think he's crazy now. They thought he was crazy when he was doing it, buying $35 billion of Apple. Now that it's over like a $110 position and people are still discussing how Apple's undervalued, they think he's smart again. So Buffett's not like most people. He's okay concentrating. Most people are not okay concentrating. It is easy to point out the history and related studies of the past to justify why one should be diversified, especially after the great financial crisis and the dot-com bubble. Sometimes a position is trimmed when it gets too large, regardless of the fundamentals. As discussed earlier in this article, the growing concentration of aggregate corporate profits amongst the smaller numbers of internet-enabled companies is the new norm, a new norm which continues to be quite foreign for most investors. And I think this is all true. He says, as discussed earlier in this article, the growing concentration of aggregate corporate profits among a smaller number of internet-enabled companies is the new norm. This is something we just have to get used to. A new norm which continues to be quite foreign for most investors. He actually goes on and cites Warren Buffett here. Warren Buffett, who faces none of the constraints mentioned earlier. So Buffett doesn't care if his portfolio looks lazy. He's not trying to put on a show to attract assets under management because he doesn't run his company like a fund. Presently has over 40% of Berkshire's public equity portfolio invested in Apple alone. Ultimately, high concentration may never be preferred reality for investors, though its appeal should broaden the investor's understanding and appreciation of its merits. As applied to big tech, grows deeper. So as you understand better what you're buying, you will become more comfortable and familiar and okay with having concentration. Another way to rephrase that is the more ignorant you are of an investment, the more scary concentration is. And so Warren Buffett is not scared of having a ton of money in Apple because once he's decided on a company, he understands the moat, the competitive advantage, and the market position, he's okay with it. He can sleep well. He knows he's making a solid investment in a very undervalued equity. That's something we're going to work on. I know a lot of people are still questioning this. This is all good theory stuff, but do we really understand Amazon and Google and Apple, Facebook, and Microsoft enough to really put a huge overweighting in those companies? That's something that I want to work on in the next, 2 or 3 parts to this series. I think it's at least going to be a 3-part series. Now, continuing on, like I mentioned before, this is going to be a longer video, so I hope you're enjoying it. If you like these type of exclusives where you do these super deep dives into the deep topics like this, let me know, and I'll try to do more of these in the future. But I enjoy this stuff. I hope you're enjoying it. This is another reason, and I think this is another good one of why these companies are potentially heavily undervalued. It's supply-demand dynamics. Given how market participants currently behave, a significant portion of the future demand of big tech shares may come from retail investors. This cohort of investment dollars is increasingly going to skew more conservative. Absolutely true. Most retail investors are very conservative, very scared, fearful investors. Nonetheless, the incremental retail demand will come from 2 sources. One, those who already own big tech and seek to buy more of it. Those are people like me that are okay with big tech and just continue adding to these positions. Those who don't currently own it. For people in the first group, it is probably already their largest positions. Check on that. Even if they just market weight big tech. So while the comfort of how much they will let their largest position run will probably improve over time, it will likely move slower than the pace of the fundamental growth of big tech. The group is mainly conservative investors. The second group, is mainly conservative investors who don't traditionally invest in growth shares. It is an incremental demand from this group that may help fuel the demand in the years ahead. So you take investors historically like me, and I've transformed a little bit over the past 5 years, but historically it was just like all about very conservative companies, almost like bond-like companies that just paid a growing dividend over time. Now I'm shifting a little bit more towards growth. I still have a heavy emphasis on free cash flow yield and the same type of, thematically, the same type of concepts that I used to study and focus on, but I've become less strict in does a company just pay a dividend or does it do share buybacks? I've kind of strayed from that into more conceptually the same thing. This is what he's highlighting here. Investors like me and ones in the retail market that have a very conservative way of investing will naturally become more comfortable over time of overweighting big tech. But it will happen after the fact, after these companies are much bigger and there's less value to be had in them. The more matured big tech is, less undervalued compared to the less matured big tech because they have a broader appeal. So that's kind of a backwards way of just saying, as the companies get bigger and more mature and they grow into those more conservative investments, That's going to attract the conservative investors. So once Amazon, like 10 years from now, is like 10 times the size and pays an enormous dividend because they have so much money, they've monopolized the retail world, then conservative investors will be like, okay, now I'm going to buy it. But it won't be as undervalued at that point, or maybe not undervalued at all in like 10 years. So, it will eventually attract these type of conservative investors, but it's when the company itself will be less valuable, or less undervalued. He says more specifically, stronger appeal to the more conservative investors who hold a lot of incremental demand. Microsoft and Apple are on a more mature and less undervalued side. So that's why those are the companies. Like I said, conservative investors have those in their portfolio. I have Microsoft and Apple. While Amazon and Facebook are on the less mature, more undervalued side, and Google is somewhat in the middle. Things that help broaden the appeal of these shares include capital efficiency, stable and increasing earnings, dividends, price per share, the volatility of the core business, limited capital commitment to moonshot investments. So those are all signs that these companies are maturing, and that attracts a wider base of investor. Attracting a wider base of investor means more capital flows to it, means the price goes up. Further, a company can improve its systemic undervaluation by engaging in stock buybacks. After a certain period of time, buybacks help the portion of the shareholder base that's the most pessimistic about the company's future to exit their positions and can help absorb supply from those needing to sell off for non-fundamental reasons, example, portfolio, waiting, using it for retirement, so on and so forth. This helps improve supply-demand imbalances and create a longer-term positive impact on the share price. The positive impact on buyback created for big tech is more than the average company buyback, as the shares are systemically undervalued and continue to be undervalued even after the buyback starts. So even companies like Apple and Google that are actively doing buybacks, they still remain undervalued even after the company's buying back their shares. This helps generate significant shareholder value, as Apple's buyback program has demonstrated. There's no other way around it. If you sell a share of Apple, there's a good chance it's Apple buying that. It's Apple themselves buying that share from you. That's how many buybacks they're doing. That does nothing but helps generate shareholder value, generate returns over time. Now we move on and we get into the company I want to focus on. And this is going to be the primary focus for the rest of this video and the next two videos. Amazon. Amazon most clearly exemplifies the above mentioned supply-demand imbalance of a company's shares. On the demand side, Amazon does little to appeal to more conservative investors. This is absolutely true. This is why I think it would cause a ruckus, I'll use that term, a ruckus, if I introduced Amazon into the passive income portfolio. People would be like, what? This company actually does dilution. They don't pay a dividend. This is a company with a 50 PE ratio. You're buying overvalued companies again, Joseph. That would be the thing everybody says. Oh, Joseph buying at the all-time high, buying overvalued companies. That would be the feedback I'd get. There'd be no, okay, this is a deeply undervalued company for the enormous amount of reasons that I'm going to go over. It'd be just a lot of criticism. So again, it goes back to incentive. For content creators coming out and saying, hey, I want to put most of my portfolio on these 5 companies. They're super boring. Everybody knows about them, but they're deeply undervalued. They're home runs. That's just not something to get a lot of attention. And doing that with a portfolio, if you're a hedge fund manager, doesn't attract a lot of capital. That's the incentive problem again. Amazon, its current accounting for its earnings are small compared to the company's true earnings potential. So this is obviously true. The PE ratio is ridiculously overstated with Amazon, which in conservative investors' minds casts doubt on the ultimate degree of long-term profit potential. The earnings are also quite volatile by big tech standards. Amazon doesn't care about smoothing their earnings and having reliable and consistent earnings quarter over quarter. Microsoft does that, I think, pretty well. They kind of smooth the earnings. Amazon doesn't care. They have Rivian in one thing, Rivian's earnings making it go through the roof, and they have other ones where they just paid a bunch of stuff and their earnings are like, nothing. It's very volatile, even by big tech standards. He also highlights that the company, Amazon, continues to invest heavily in its core business as well as various moonshots. The company provides zero financial and other disclosures regarding its moonshot investments. They don't say a thing about them. And we're going to go in later in another episode of how much they're spending on their moonshot investments. It's ridiculous, but we'll talk about that in a bit. Amazon pays no dividend. Amazon would have been in my portfolio probably a couple of years ago if they did pay a dividend, but they don't. So that does rule out investors. If you buy SCHD, you're not buying Amazon there. On the supply side, it is the only big tech company that doesn't engage in buybacks. That is true as well. If we go to Qualtrim here, we look up Amazon, their share count is being diluted. So you can see the dilution here. It's not huge. This actually dramatizes a little bit because it starts at 478 million and it ends up here at 509. So it's not a massive amount of dilution, but Amazon is diluting right now. And this is the reason why. It doesn't engage in buybacks. Today, it does not benefit from the above mentioned impact. Further, Amazon has a relatively low cap on the cash portion of their typical employee compensation packages, which encourages a greater incremental supply of shares added to the market as employees sell down their vested shares. Jeff Bezos and Mackenzie Scott together add more supply to the shares into the market than other big tech founders, because Bezos has owned a lot of the companies. And this large imbalance likely makes Amazon the most undervalued big tech company today. AWS, for example, trades at a price to sales multiple to the already undervalued. He still says Microsoft's undervalued. All big tech is undervalued, in his opinion, heavily undervalued. But he's just saying that Amazon is the most heavily undervalued. AWS, which is Amazon's web services, trades at a similar price to sales multiple to the already undervalued Microsoft. Despite a much greater growth potential and margin upside, Amazon exemplified how a $1 trillion company's growth mindset, which most certainly creates long-term shareholder value, can indeed harm its medium-term valuation. That's a big statement to make. Amazon already knows that they don't care about short-term, medium-term profits. It'll turn out just fine. They've been doing this playbook for like the last 20 years, and they're still doing it today. They don't care about attracting investors' money. If they did, they'd pay a dividend. If they did, they'd show their moonshots, their budget, they'd segment things out. They don't care about doing that. But anyways, nevertheless, the business will eventually move up the maturity curve, and the company will behave more like a mature company, bringing the twin benefits of margin and valuation gap improvements to the long-term investor. So that is it. That is the end of part 1 of this 3-part series. Just a reminder, part 2 is going to be released next Friday. So bookmark it or whatever, subscribe to the channel, and you'll see part 2. I think part 2's even better than part 1. It goes more specifically into Amazon and the many hidden ways this company's creating value. I think it had a lot of good feedback. So part 2 is really good. But I'll be releasing that next Friday. If you want to skip in line and watch it right away, you can join the Patreon. There's a link in the description. If not, just check it out next Friday. But other than that, I'll see you in the next one.